Hello, everyone, and welcome. My name is Kelvin Ndoro, and I have the privilege of serving as the new professionals chair for IPEC Nova Scotia. On behalf of my colleagues at the Institute of Public Administration of Canada, I am pleased to welcome you all to what promises to be an exciting presentation on housing. This is a hot topic in Nova Scotia currently, and we're planning more content for you in the future. If you have a question that you would like to ask, please enter it into the chat on YouTube. Towards the end of the discussion, we'll have some time to bring in audience questions. My colleague, Emma Miller, will lead this discussion. At this time, I would like to introduce our speaker for the day, my very good friend, Kelvin Ndoro. Kelvin is a Senior Analyst, Economics with the Canada Mortgage and Housing Corporation, CMHC. He is part of a team of housing economists and researchers who strive to improve their understanding of housing markets dynamics and how they impact affordability. He provides economic insights to better understand, solve, and strengthen current and future challenges in the housing system. He also actively contributes to different discussions from the public, from public speaking and media engagement. This work is all in support of CMHC's aspirations of housing affordability for all by 2030. Prior to joining CMHC, Kelvin worked with the Nova Scotia government in different roles, with the last role being as Senior Economist with the Department of Labour and Advanced Education. At this time, I hand over to you, Kelvin.
Cool. Thank you, Talent. Welcome, everyone. I'm happy to talk to you today about the Nova Scotia rental market, and I might focus more on Halifax. But like Talent said, this is a hot topic in not only Nova Scotia, but in the country. But just to give you some perspective of what you can expect from my presentation today, to start, I'm going to provide an overview picture of rental market condition and trends in Nova Scotia and Halifax. And I will also compare with regional results with other cities in Canada to provide some context. And finally, I hope we can have a discussion on what we can expect with regards to impacts on affordability, federal, provincial, and municipal policy implications. And I hope at the end of this presentation as well, you have a better sense of what are the most important questions and how do we answer them. So over the next few slides, I'll discuss some key trends from our 2022 rental market report. So just to give you an overview of what we mean when we talk about the rental market universe. According to Statistics Canada, there are 81,000 rental households in Halifax. Our rental market report focuses on primary built units in structures with 3 or more rental units. And there are only those units that are intended to serve the rental market. These units fall into 2 types of structures, which are apartments and private row, which in some areas are also referred to as townhouses. The rental market also has a second major component, which we call the secondary rental market. And with the secondary rental market, on the other hand, this consists of units that were originally intended to serve the ownership market, including in the special case of condominium ownerships, which were not intended for the rental market. However, the owners of such units might decide to put them back onto the rental market. So despite their initial ownership purpose, these units end up serving the rental market as well. CMHC focuses its data collection in the secondary rental market on condominium apartment rentals. We collect condo rental data in 17 major centers through what we call the condominium apartment survey. That's also done at the same time that we do the rental market survey. Lastly, we also have the social and affordable housing, which we started in 2018. The target population for this survey is all structures in provinces and territories with at least 1 rental unit subsidized by a public entity. So this could be a public entity like the federal government, provincial government, or municipal government, and it can also be non-profit co-ops or faith-based organizations. So most times when people are talking about our rental market data, they are talking about apartment rentals. But that's in Halifax, for example, this only about 68% of the rental market universe. And in some cases, and not all markets, we don't have data for the secondary market, that's secondary rental units. So when we continue our discussion today, I'll mostly be talking about the rental apartments, but we should also keep in mind that there's a much bigger rental market universe. So, based on our 2022 rental market survey, national rental market conditions tightened due to rental demand rising in many markets across the country. The Canadian average vacancy rate was 1.9%, and this was the lowest national vacancy rate since 2001. The vacancy rate in Halifax was 1% as of October 2022, and it was below the national average and the second lowest after Vancouver when we compared that among the major cities in Canada. So the divergence between vacancy rate among Canada's largest markets reflects differences in their gaps between demand growth and supply growth as well. So Western cities, as you can see from my chart here, with the exception of Vancouver, had relatively higher vacancy rates compared to Eastern cities. However, the decline in the national vacancy rate was widespread, reflected widespread tightening across Canada's rental markets. Only 5 of the 37 major cities that we survey saw vacancy rates increase, but otherwise there was a decline across the board. So when we look at Nova Scotia, while most of the public focus in Nova Scotia has been on the low vacancy rate of 1% in Halifax, most regions surveyed outside Halifax within Nova Scotia had even lower vacancy rates. So for example, as you can see from my map that I have, Kings County, which is a darker color, and East Hants had almost close to 0% vacancy rate. Kenview and Truro had vacancy rates lower than Halifax as well, at 0.9 and 0.7% respectively. Cape Breton had vacancy rates of 1.5%, which it's still higher than Halifax, but it's quite significant given that Cape Breton has generally had high vacancy rates between 6 to 3% over the last few years. So before I get into the discussion of talking about average rents, I just wanted to kind of give a little bit of an overview of how we cover rents at CMHC. So sometimes you read reports from other sources that provide rents from web listings. However, these sources have data issues, and we strongly recommend to use CMHC's most robust data source from sampling all rental units in the market. So in this case, I'll just give you an overview of our average rent, and I'll use Halifax rent numbers to illustrate the difference. So normally when we report the average rent, this is for all units occupied or vacant. That's the number that's normally released in the media and people talk about. But sometimes we do get cases where people ask us and tell us, well, the numbers you are presenting don't reflect the reality on the market. So, but we do also provide from the average rent, we provide the average rent for occupied units and also the average rent for vacant units. So the average rent for vacant units in Halifax was 1,600, which is slightly higher than the 1,450 that would have been advertised for a 2-bedroom apartment. So the 1,600 is usually what people would see when they are looking for an apartment. But in 2022, given that some jurisdictions started having rent control legislation that puts a cap of how much rents can increase, we decided to provide new data that shows what a new tenant would expect to see for rents. So in Halifax, the average rent for existing units that were occupied by a new tenant was 1,760. And this was slightly higher than the average rent with existing tenants that was at 1,400. So this data is new, and it helps us understand the different sorts of affordability challenges faced by different types of renters. So now talking about the rent, the overall same sample average rent increase or in Nova Scotia was 8.4%, and this was the highest single year increase. In Halifax, it was 8.9%. Um, so this was despite Nova Scotia legislation a temporary 2% rent cap for existing leases in November of 2020, which was subsequently further extended. So inflation, we know inflation has increased across the country for all goods and services, and rent wasn't immune to that. The increase we saw in Halifax was significantly higher than the long-term annual increase in rents of 2.5%. And we can see in the last 4 years, the average rent has been consistently above the long-term average, whereas like in the past, with or without any form of legislation, we've been able to oscillate around that 2.5%. So rent growth reached a new high due to tighter rental markets in most of Canada's cities. In Canada's major cities, which we call CMAs, it rose to 5.5% from 2.9% in 2021. This was also a new high for Canada as well, which was above the long-term average of 2.8% rent increase in Canada's large cities. In Halifax, with an average rent of 9.3% for a two-bedroom apartment. This was the highest increase in rent for a two-bedroom apartment in the country, and quite significant compared to the 4.8% that we saw in 2021. So what does this mean? From this chart, there's lots going on this chart, but this chart is showing the relative affordability across Canada's cities. So on the chart, I'm showing you the number of hours a person earning an average hourly wage would need to work in a month so that rent payments do not exceed 30% of their total income. As you can see from my chart, Halifax is one of the least affordable cities in Canada after Vancouver, Victoria, and Toronto. An individual in Canada, in Halifax, would need to work 178 hours a month in order to keep rent affordable. And assuming that people work 37.5 hours a week in a month, that amounts to about 150 hours. So what we see in this chart is like uh, a full-time job is not enough in order to keep rent affordable in Halifax. So even when we compare to 2021, Halifax, the number of hours somebody would need to work to keep rent affordable in Halifax was at 163 hours. So within a year, an individual now has to work 15 more hours in 2022 to keep rent affordable compared to the previous year. So on the next chart, like in our in our rental market release, we have a table where we've grouped renters into 5 quintiles, which with each quintile representing, how do I put this in an easy way? So each quintile represents 20% of the total rental population. So the first quintile on my chart here includes the 20% of renters with the lowest incomes. The second quintile will be the next 20% of renters on the income scale, and so on until the fifth quintile that captures the 20% of renters with the highest incomes. So using this framework, a simple benchmark for an equal distribution of affordable rent supply across income quintiles is when each quintile or each income group has an equal share of the rental stock that is affordable to them, exactly 20%. So that is represented by the orange line on my chart. So the blue line represents the share of rental units affordable to each income group from the lowest 20% to the highest 20%. So what we see in this chart is that the affordable share of the rental stock is less than optimal for the bottom two income quintiles. For the bottom 20% of income earners in most rental markets, the affordable share of the rental market is much less than 20% of the stock. So you can see that the lowest 20% of the income group only has 3% of the rental stock that's affordable to them. The next 20%, that is 40% of the population, has only 37%. And it's only after that that we see that people in higher income groups have more of an equitable share of the rental stock that's affordable to them. So when we look, this chart compares the same data that I was just presenting for the lowest income group across different markets. So what we see here is for the bottom 20% of income earners in most rental markets, the affordable share of the rental market is much less than 20% of rental units. So the Halifax is at 3%, which is at the lower end. Quebec centers such as Montreal and Quebec City, represented in this graph, generally have a higher share of their rental market that's affordable to the bottom 20% of income earners. So while this indicator assesses affordability, one thing to keep in mind is that it does not take into account factors like suitability and adequacy of the unit. It just shows you what people in different income groups have accessible to them that is affordable. So in Nova Scotia, the average rent growth for purpose-built two-bedroom units that turned over to a new tenant was 28%, well above the 4% increase for units without turnover. So that's units with the same tenant, the average rent increased about 4%, and with new tenants, it increased about 28%. So essentially, landlords are generally free to increase rents to current market levels once the previous tenant vacates the unit. Hence, we see the big jump for rents that are for units that have been rented to new tenants. And landlords can also take this opportunity to renovate between tenants, raising unit quality and allowing them to ask for higher rents from new tenants. So when we compare this data to major markets in Canada, I think only Toronto had higher turnover rent increases than Halifax. Well, unfortunately, high turnover rents affect the most mobile and vulnerable populations in our communities. So we're talking about recent immigrants, students that are also very mobile, or some new students coming into the city, or some that are wishing to move off campus from living on campus. We also have job seekers, somebody who might be looking for a job from outside of Halifax, wanting to find a job in Halifax and so forth, or people even moving between Halifax and Dartmouth, for that matter. They're now faced with much higher rents when they're looking to move. Low income households as well, it does not allow them to upgrade even when their families are growing. For example, upgrade to a newer and bigger unit because they are then faced with much higher rents. And essentially what happens is families in core housing need have a hard time getting out of core housing need as they are stuck living in units that are not adequate or suitable for them. Um, So when we look at this data nationally as well, we see that rent growth for purpose-built two-bedroom units that turned over to a new tenant were well above rents for units that did not turn over. So on this chart, you can see that the spread in rents between turnover versus non-turnover units was wider in markets with low vacancy rates. Also, when we group different markets by the rent control regime in place, we noticed the gap was wider in markets with stricter rent control measures, as depicted in this chart. The cities at the top of the chart have a much wider gap between turnover and non-turnover rates. Other jurisdictions such as Quebec and Manitoba have rent control guidelines, meaning there isn't necessarily a limit of how much rent can increase by, but there's oversight. Landlords can justify rent increases, or tenants can appeal rent increases, and so forth. So with this market, you can see that the gap was not as wide as the other markets at the top of the chart that have a rent increase stipulated. At the bottom of the chart are cities in Alberta, Saskatchewan, and Newfoundland, which do not have rent control legislation at all. And in these cities, we don't see a gap between units that have new tenants and units that have the same tenant. And indeed, when you look at the average difference in rent between turnover and non-turnover units as depicted in this chart, you can see it dominated by cities in Ontario, BC, and of course, Halifax, Nova Scotia. And these are jurisdictions that had rent increases capped. And so, yeah, the difference in rent is substantially higher in these provinces. Um, so, what does that mean, or what is driving this gap that we see? Well, the combination of very high rents and lower vacancies, what it essentially does is it provides a disincentive to move. So there's less likelihood of finding a comparable unit, and thus leading to lower turnover rates. People less likely to move. So as I've been talking about that short in the last two slides, in regions where there were rent increase caps, tenants are protected by a rent cap and decide to stay in place. So, well, this now means property managers have less units from which they can increase rents to cover their increase in corporate operating costs. So, the lower the turnover rate, the higher the rent increase is on turnover units, that is, units that are being rented to new tenants. And essentially, what that implies is that turnover units are thus subsidizing non-turnover units in markets where there are rent caps. So our rental market report also shows that, in this case, I'm showing data for Halifax, there are few existing options for low to middle income household. This chart builds on the income quintiles I was talking about, and shows the vacancy rate in gray for each segment of monthly rent, which is in blue. That's affordable to each income group. Here we see the vacancy rate for rental units priced lower than $700 and affordable to the lowest 20% of household income was 0.8%. When we move further up the income groups, the vacancy rate is 0.6%. For the second income quintile, and gradually goes up to 2.5% for the higher priced units that are affordable to the highest income group. So unfortunately, this scenario means there's even more competition for units that are affordable to low income households, as depicted by the low vacancy rates. Tenants who can afford to move to higher price units end up not moving because they are protected by a rent cap and do not want the prospect of even higher rents as a new tenant in a different building. So what does rent look like elsewhere in Nova Scotia? So average rents are much lower elsewhere in Nova Scotia, especially in areas just outside Halifax. Um, when the average rent in Halifax for existing vacant units is at about 1,800, there's an incentive for people to move to these areas where rent is more affordable. And as you remember in my previous chart, I did show that the vacancy rate in areas just outside Halifax were much lower than Halifax. So we're seeing more demand as people move into these parts of the province. Remote working is also making it easier for people to move outside of Halifax without losing their jobs and also have an affordable place to live. So next, I'm going to talk about what is driving the numbers, what is driving what we are seeing in the rental market. Um, we have a rebound in net migration, which had slowed during the pandemic. We also have the challenge of home ownership. Students are also a big factor that are affecting rental markets. And with the return of in-person learning, we've seen more and more students coming back to our province and to our city. And finally, on the supply side, the first three factors that I talked about are focusing on demand, but there's also supply issues. We have supply gaps, and there are also issues impacting construction. And in the next few slides, I'll briefly touch on some of these issues. So one of the key factors is population growth. Nova Scotia's population grew faster last year than in any modern data series. As more people move to Nova Scotia, there is therefore an increased need for more housing and other infrastructure support. I mean, Atlantic Canada in the last few years has been leading the country in terms of population growth. PEI, New Brunswick, and so forth. In last year, Halifax had one of the fastest growing urban centers in the country. The municipality grew by 4.5% in 2022, adding almost 20,000 people. It was only second in population growth to Moncton, which grew at about 5.4%. So what I'm showing you on this chart is that the majority of the influx comes from international migration and people moving to the city from other parts of the country, which I call interprovincial migration. That is the orange on my chart. And then international migration is the green. But we also have non-permanent residents, which also includes people on temporary foreign workers, students, and so forth, which is in the light green. But also what we see from this chart is that there's also a small increase in people leaving Halifax. So we can see that is denoted by the blue. The blue shows intra-provincial migration, that is people moving from other parts of Nova Scotia to the city. So that has been decreasing over the last few years. And in 2022, that number was actually slightly negative, meaning that we lost more people to other parts of Nova Scotia than people that moved to Halifax. So people leaving Halifax for other parts of the province has resulted in strong population growth in areas such as Kentville, Truro, New Glasgow, and even Cape Breton. Another factor that has been affecting the housing market and also the rental market is interest rates. In the past year, we've seen record inflation, of which rent is a component of that as well. And in some regions, such as Ontario, BC, Nova Scotia, and PEI, the rent component of the CPI increased faster than wages. So in order to combat inflation, in the past year, the Bank of Canada has increased interest rates 8 times, totaling a combined 3.75 percentage point increase in the key policy rate. This was the fastest increase in less than a year. And as such, the historical increase in the key policy rate has had a significant impact on the housing market. At CMHC, we believe that everyone should have a safe and affordable place to call home. However, for too many Nova Scotians, including young people, new immigrants, the dream of owning a home is increasingly out of reach as well. Uh, well, when you look at some numbers, the average salary needed to buy a single detached home in Halifax is about 123,000. For a semi-detached house, it's slightly cheaper at 115,000, and for a condo, it's also slightly cheaper, but also over 100,000 at 107,000 of household income. Um, for a two-bedroom rental unit, a household would need an income of about 86,000 in order to have an affordable rental. So, but then when we look at the income, the median household income in Halifax is about 85,000. So this further illustrates how housing affordability directly impacts apartment rents. So even though rent is becoming increasingly affordable, it remains the lowest cost option for most households. And the cost to own a home is significantly expensive across much of the country, and particularly in the two biggest cities of Vancouver and Toronto. Halifax, however, remains relatively more affordable in comparison. So this explains why in recent years we've seen more in migrants from Ontario and BC who are mostly buying relatively cheaper homes in Halifax or renting, and that's further increasing the cost of housing in the province. Because home ownership is increasingly out of reach for a majority of Nova Scotians or Canadians for that matter, especially young people, like I mentioned before. And these young people are typically first-time home buyers. The proportion of young people renting has increased in the last 10 years. Um, in Nova Scotia, the proportion of young people under 35 who are renting increased from 59% in 2011 to 63% in 2021, as is depicted on my chart. Um, and this was higher than the Canadian average, which stands at 58%. So not only are young people staying in rental longer, some are choosing to stay home with their parents or relatives instead of renting altogether. And I did allude to this in my 2022 rental market report. As I mentioned earlier, the return to campus for after so much remote learning during the pandemic has been among the drivers of the tight rental market. The impact of international students is more significant as they are more likely to rent than domestic students who might have family nearby to live with. Uh, so with the return to in-person learning, we did see that student-dominated rental zones had much lower vacancies. So, for example, in Halifax Sound Edge, the vacancy rate there was 0.6%, dropping from 1%. In Kenville, in the Annapolis Valley, it was 0.9%, dropping from 1.5%. And Cape Breton, Sydney had the vacancy rate there, 1.5%, dropping from 6.1%. So there's quite a significant impact from students coming back to college campuses. Uh, and as you can see from this chart, like the share of international students attending University of Nova Scotia has grown from about 13% of enrollments in 2011, 2012 to about 23% in 2021 and 2022. So while universities have done a great job recruiting international students, um, there haven't been a significant addition to on-campus housing. So this is leaving students to compete for the same rentals in the private market as everyone else. So for example, in Halifax, there are about 33,000 students, and about 80% of those students live off campus. Uh, that's accounts for about 11,000 units of the rental stock that are rented by students. So as rental options become fewer and further between, we've had reports of some students commuting from outside the region. Some students are couch surfing or piling multiple roommates into the same bedroom. Ultimately, this has an impact on core housing need. So when we talk about core housing need helps us to um, identify households living in dwellings that are considered unsuitable, inadequate, or unaffordable. So in the 2021 census from Statistics Canada, um, Halifax was ahead of Vancouver, Ottawa, and Toronto in the percentage of racialized groups who can't afford housing that's in good repair or suitable for the size of their family. When we compare that to the 2016 census, Fredericton and cities in Ontario, such as Toronto, Barrie, and London, Ontario, were slightly ahead of Halifax. But for 2021 census, Halifax ranked first. So this may be related not only to the cost of housing, but also to how recently some of the people have arrived in Canada having trouble finding suitable, adequate, and affordable housing. And that's, they have no choice but to cram in limited spaces just so that they can have a place to live. On the supply side, Halifax has seen a steady increase in rental completions over the last few years. In 2022, as depicted on this chart, like we had a record increase of about 2,000 completions in a single year. Um, However, in the rest of the province, um, there has not been a significant increase in new rental units over the years. So, as you can see from this chart, in 2022, only about 300 units were completed in the rest of Nova Scotia, compared to the 2,000 units that were completed in Halifax. But still, this supply growth is not meeting growing demand, leading to low vacancy rates across many of the regions in our province. And like to better illustrate my point, like the next chart that I'm showing you right now, uh, shows rental completions relative to the population for Halifax. The most notable declines of rental completions in Canada, and Halifax is part of that, occurred in the least affordable markets. Markets with the fastest rent increase saw the sharpest declines in rental completions. So I'm talking about Vancouver and Toronto, and most markets have not resumed the pre-pandemic pace of rental construction. So as you can see in this chart, because population is growing faster than supply, even though 2022 had the highest number of completions, when we put that relative to the population, it actually had much fewer rate of completion than previous years. Halifax, however, has among the highest proportion of new market rental units built in the last 12 years. 2 years ago, Halifax was leading the country on this metric, but it's since been surpassed by Moncton, Charlottetown, Edmonton, and Calgary. Uh, while not helping affordability directly, increased supply does allow renters to increase supply of new units, even though they are coming at a much higher price, allow rentals to move up to better units, opening up lower cost units for low income households. The private rental market in Halifax has responded to the need for more units. This is reflected in the fact that 49% of rental units in Halifax were built in the last 23 years. 7% of those units about 3,700 units were in just in the last 3 years. More impressive is that more than a quarter of units were constructed just in the last 12 units. But unfortunately, at about 1,000 units added per year, it is still not enough. But what's even worse is that when we look at the social and affordable housing, the picture there is unchanged since the early 90s. Only 2% of units have been built since 1996. That's only about 160 units. So we've seen a much better response in the private market than we've seen in social housing. So what we need to do is build more non-market housing to improve housing affordability. And I'm just going to use this chart here to go back to simple supply and demand. Uh, Supply of non-market housing will always be needed to ensure affordability for everyone, because housing markets work in a housing markets are not perfect. Producers are incentivized to produce more supply, more units, housing, rental or not, because they are assured of profits in the short term, but not necessarily in the long term, as there are no barriers to entry to the housing market. So as there is more profit to be made, more people are going to enter the market, therefore reducing the price that property managers can ask for their unit. So this means the most effective solution is to find ways to increase supply, and that needs to come from non-market housing. And by increasing supply, we can then reduce the price to something that is more affordable, because the prices that are charged in the private market are prices that make it feasible for more housing to be built. But sometimes those prices are not generally what is affordable. So the only way to do that is uh, to increase supply. Um, Another option is to reduce demand if we wanted to come back to a price that is more affordable. But that is not as easy as well. As we know, our population is growing really fast, and the housing market uh, is not as affordable and so forth. So yes, we can look at some demand factors in order to make housing more affordable. But at CMHC, we do believe that the more sustainable and more effective way in order to make housing more affordable is to increase supply. So that means we need to, like when we think of housing, I'm sorry, like when we think of housing, we have to look at housing as a spectrum. And when one area of the housing spectrum is unhealthy, the whole spectrum suffers. So as we have seen from a presentation and stories across Canada, rental markets are absorbing the growing need for housing. And for a while, rental supply has responded to this growth in demand, but it's not enough anymore. This is why it's so important to the health of our housing market that we have appropriate supply of rentals, shelters, long-term care, and more, and increase supply across the entire spectrum. So before you go to bed tonight, I encourage you to grab your tablet or phones and read our recent report that illustrates the challenge we face to address the housing supply gap in Canada. In our report, we project that if current rates of new construction continue, the housing stock in Canada will need to increase by 2.3 million units. So this between 2021 and 2022 and 2030, reaching close to about 19 million housing units by 2030. So to restore affordability, we project Canada will need an additional 3.5 million units. In Nova Scotia, the housing stock will increase to 520,000 units if we continue under the business as usual scenario. But this leaves an additional 50,000 units needed to restore affordability. So this projection is over an 8-year period, meaning we need about 6,000 annual housing completions in Nova Scotia. And currently, right now, we are completing about 4,000 units. So each year we are about 2,000 to 3,000 units short. So to put this into financial perspective, assuming a construction per unit of 300,000, nationally, what this means is we need $1.2 trillion of new housing. And in Nova Scotia, that's about $16.5 billion in new housing in order to restore affordability. So the challenge that we have is quite significant, but it requires not only the private sector, but all levels of government and everybody to come together to ensure that by 2030, everyone in Canada has a home that they can afford and that meets their needs. And if we can do this, that will be good. So thank you very much. That is my presentation, and we'll open up the floor for discussion and some questions.
Thank you, Kelvin. Hi, everyone. I'm Emma. I am the vice chair of IPAC, so I'm going to be moderating the QA. So with that, we will open it up, as Kelvin said, to some questions. So we are monitoring the YouTube chat for those questions as they come in. So if you have one, please post it in the YouTube chat and we can pose it to Kelvin. So I'll give it about a minute or so. I know that I have a couple questions, and I know some folks from IPAC also do. But I guess I can kick it off. So you spoke a bit about kind of shelters and transitional housing, and so my mind went to kind of community organizations that are supporting those types of shelters and homing situations. So I was wondering what kind of research or data CMHC has, or partnerships that relate to specifically shelters and transitional housing and kind of community organizations that are supporting them, if you could speak to it at all.
Yeah, so in my presentation, I mentioned the social and affordable housing survey. So this is a survey that CMHC does after our rental market survey. So it looks at nonprofit housing, essentially. So all rental units that receive subsidies from the government and so forth. So we do look at that data, and we have that data available. We look at the condition of those units, the vacancy rates, and so forth. I think we could improve on data on homelessness, but because just of the nature of homelessness, where people are constantly in and out, it's very difficult sometimes to have consistent data on that. But it's something that we definitely working on at CMHC.
Awesome, thank you. Just looking to see if there's any more questions rolling in from our viewers. I'm not seeing any as is at the moment.
No questions. Wow.
I know. Your presentation was so thorough.
I was expecting lots of questions.
Yeah, I will keep an eye on the YouTube chat. Oh, here we go. So what are your thoughts on different kinds of social housing, such as co-ops and public housing? Is there a type that's best? So that is a question from one of our viewers.
I don't, to be honest, I don't know if I'm the best place to answer such question. But I think like a lot of co-ops, as I know some people went to co-ops, like they do a really good job of maintaining their properties and their tenants. So if I were to pick, I think we would need to encourage more co-ops. Not to say that public housing isn't good, but sometimes I just think like maybe co-ops can respond quicker and faster to the needs of people that need housing.
Awesome, thanks. We'll see if any other questions come through or if there's follow-up from the audience on Kelvin's response to that question. We do have time for about 2 more if folks are going to have them roll in. So I guess I'll build off of that. When you mentioned co-ops seem to be faster in terms of kind of responding, could you speak at all to why that is?
Can I speak to why that is?
Yeah, so why might co-ops be able to respond faster, I guess is the question, or follow-up, sorry.
I think this is just from experience. I don't want to throw shade on people that are managing public housing, but just from experience and from the conversations that I have had with people in this sector, there just seems to be a better response to the needs of people.
Awesome. We do have another question come in, and folks are thanking you. So as interest rates are up, construction costs and labor, what are your thoughts on government subsidies and tax breaks for developers? As unless there is profit margins, it's hard to make projects happen.
I mean, that's a very good question. Because like already in Canada and in Nova Scotia and Halifax, as interest rates have gone up, inflation has gone up, the cost of construction has gone up already as well. And we're starting to see a slowdown in construction, right? Because projects are just not feasible anymore. So I think this is a very important time for all levels of government to jump in, whether it is reducing government charges, development costs, and so forth, so that we can have more housing being built. I think that would be really key because the situation is challenging for everybody, tenants, property managers, developers as well.
Awesome, thank you. Another question coming in. So would you say that the growing demand is a major factor or the impact of the supply of building materials? It is there at the bottom of the screen.
I think it's a bit of both. It's a bit of both. Like I mentioned, the Halifax market has been so good at responding to demand. We build more apartment rentals per capita than most areas in the country, faster than Toronto or Vancouver, right? But I think the situation is just becoming more challenging because demand is growing faster. We have not seen anything like this in Atlantic Canada. And I think when population started kicking up in 2015, 2016, 2017, maybe supply was a bit slow to respond because the question was always, is this sustainable? Can this level of growth continue going forward, right? But 5-6 years down the line, we're seeing that our population continues to grow. So there's a lot of catching up there to do, but definitely the pandemic did not help. It slowed things down a bit, and after the pandemic, we had the increase in costs of everything that also just made the situation worse.
Thank you for your response. So I do think that is time on questions. So I do wish we had a bit more time to get through them and they were rolling in. So, but I just want to say on behalf of IPAC Nova Scotia, we hope that folks tuning in enjoyed this event, and we really wanted to thank you, Kelvin, for.
I think John had one more question there.
Oh yeah, sorry, I did not even see this. I'm looking at the YouTube one. What kind of policies can you propose to encourage more social housing?
I think we need to see more from government. But one thing I would say, as I think I illustrated in my presentation, is the private market is more efficient in producing housing, right? Like they are more experienced than the government for that matter. So if there's a way we can encourage more of that government money, to encourage developers to come forward and help the government build more social housing, that would be great. But I mean, there's lots of different policy issues that we can discuss. But I think the most important thing is like when we're making policy, for it to be evidence-based and for us to assess the trade-offs involved. And when we're making policy, we need to view it within the overall context of housing supply and demand, because some of the policy prescriptions that people propose fail to understand the other side of things. There's a bit of a singular focus in policy. So what essentially ends up happening with bad policy is, even if it is imposed with good intentions and may provide short-term benefits, sometimes it does result in disincentives to supply, and potential tenants being excluded from the housing sector altogether, and ultimately makes everything worse. So we just need to keep that in mind when we're thinking of policy.
Thanks, Kelvin. It's awesome. Awesome. So I guess I'll go back to thanking you again, but
No problem.
for all of your insight today, and thanks folks for tuning in. We appreciate your attention, your questions. This is always a great time to say, for those watching, if you haven't yet become a member of IPAC, please consider doing so. And check us out on our website, LinkedIn, all that kind of stuff. We are building exciting upcoming content on this topic for a future meeting, and we're excited to see you all hopefully tune in there as well. And we look forward to seeing you at our next events in the future. We hope that everyone has a great night, and thanks again for tuning in.
Thanks, everyone.